Okay, well, so we have to prepare a balance sheet, and in this balance sheet we have to transactions are not arranged in that order. And then we have a Jacksonville Corporation on March 30 20x1 as a date. So let us just name our transactions as asset, like A is for asset, L is for liabilities, and then we have OE for owners or owners equity. So in this case it's corporation, so that's owners with a S. So owners equity for a corporation or company. And then we have cash. We categorize it as asset. Notes payable will be a liability. Notes payable is what you owe in the bank. Merchandise inventory, that's the stock you have, so that's asset. And then paid in capital means that it's owner's equity, so that's the shares, money you paid for shares. And land is considered as an asset. And then we have accounts payable, the amount you owe creditors, so that's liability. Furniture and fixtures, these are things that are not attached to the building, like computers, tables, and so forth. Long-term debt is what you owe if you owe a company or a bank for a very long time. Building is actually considered as an asset, so long-term debt is liability. Machinery and equipment, so those are things that actually creates money for you, so that's an asset. And that's it. From there, let us deal with cash. We have in merchandise, we have land, we have furniture and fixtures, we have building and asset, we have machinery and equipment, all of that and assets. And then we have notes payable and the liability, that's what you owe the bank. Long-term debt is either to the bank or to the creditor. Accounts payable, so that's what you owe the creditor. Paid in capital, so that's the capital you have in shares or amount you paid to just initiate the company. And then we're going to look at one there. We have purchased merchandise for that's on account, so that's credit, and then that's the amount that we have. It's $3,000, and that means $3,000 it's merchandise is asset, and then account payable, so which means that you acquired asset, but at the same time you owe people for that asset. So that's what actually it means. And then we are going to look at first transaction, which is all the money that we have there is in dollars. Cash, that's 14,000. So we know that we need to have a balance brought forward. Okay, so we always start with what we have. If it's 00, that's the beginning of the company, but if the company has operated for some time, then we need the balance brought forward. So we're gonna say balance brought forward. We fill in all the informations that we have. Cash is 14,000 there, so we have 14,000 cash, so we record it under cash. That's dollar, that's 14,000. Okay, so for the $14,000. And then next we go for notes payable. So remember, it's not in what particular order. So notes payable, we have it in liability, which is in dollars, and the amount is 10,000. So notes payable 10,000, the liability. And then we have machinery inventory, so that's 40,000, that's an asset. So machinery merchandise inventory, so that's 40,000. Merchandise inventory 40,000 and the asset. And then we have paid in capital, or as OE, paid as shares, so that's paid in capital, so that's 80,000 there, paid in capital. And then we have land for 14,000, so land is under asset, so we go to the asset part, and then land, we record it there. Remember, everything's in dollars, so that's going to be $14,000. And then we go next to, okay, that's a land account payable, that's 8,000. Then we go to the account payable, account payable there, which is going to be 8,000 there, so that's 8,000. And then we go to the next transaction, which is furniture and fixtures. That's under asset. It includes everything that's movable, like computer, table, whatever that is not attached to the building. So that means furniture and fixtures, so that's $3,000 for that. And then we go next to the next transaction, which is long-term date. That's a liability. That's, remember, it's balance brought forward, we just record as it is. So liability, that will give us 12,000. So 12,000, that is our liability on a long-term date. And then we have building. The building is worth 24,000. So it could be what we bought it or what we used to construct the building. So it's going to be 24,000 there. And then we go to the next transaction, so which is machinery and equipment. That's 15,000 asset. So it's machinery and equipment. We go to the machinery and equipment. So that's machinery there and equipment. So that's 15,000. So balance brought forward. So let us see if the balance. If it doesn't balance, then it means we can't proceed. So 14,000 plus 40,000 plus 14,000 again, plus 30,000, and then plus 24,000. That gives us plus 15,000. That gives us a total of 110,000. So on asset we have $110,000, and then from there we move on to the next one. The next one there, which is 10,000 plus 2,000 plus 12,000 actually, and then plus 8,000 there, and then plus 80,000, and there, let's see what it adds up to, 110,000. So the balance brought forward has balance. So if you have recorded it incorrectly, then that means that you're not gonna get it balanced. So the balance brought forward is balanced, and then now we can proceed with the transactions on the following day. So proceeding with the transaction there, proceeding with the transaction, we have our first transaction there. Let us concentrate on our first transaction, which is transaction number 1. Construction number 1 is 14,000 cash. So we have cash there, which is okay. Purchase merchandise on account for 3,000. So that's created. Okay, so merchandise, so you get asset, and you also have liability there as credit. So accounts payable, which is liability, and then we have our merchandise there as cash. So that's our first transaction. So first transaction, we go straight, we record that $3,000. So it's going to be under machinery and equipment 3,000, and then account payable, because we owe the creditors that amount. So that we owe the creditors 3,000 for the asset of 3,000, and we bought machinery and equipment with that money. And then the next transaction, sold at cost of 1,000 cash. So that cost 1,000. Some furniture that was not needed, so we bought more furniture that's not needed, so we sold part of it. So we can see that there's a transfer of asset. So that means that you have change of transition of assets. So change of type of asset. So the asset changed from furniture. So we changed that furniture to cash. Furniture is asset and cash is asset. So we lost the furniture, but we got the cash under the same value. So our second transaction will be that under furniture and fixture, we have lost negative 1,000. It's negative, but we also gained cash for the furniture that we lost. So nothing was really lost, we just changed the asset. And then next we go to the third transaction. Okay, so we're still dealing with transactions there. So third transaction there, that's 3, and then that's additional capital stock for 12,000. So that means that we have 12,000 signed shares worth, so the 12,000 was worth of shares. So we actually sold the shares, and then we're going to get cash when we sell it. So selling it, owner's equity is 12,000, and then what did we do with the 12,000? We bought machinery and equipment for 12,000. So machinery and equipment 12,000, and then the third purchase was land for 25,000, and we paid 10,000 cash, and then remaining being 5-year loan date. So we all loan for 5 years long term. Anything more than 1 year is long term. So our price, the original price is 25,000. So that's 25,000, and then the land cost 25,000, which is an asset. So we record that as an asset. So we go to the land, quickly to the land there. That's transaction number 4. We go to the land, which is 25,000 that we acquired. But at the same time, we paid cash. Our cash is 10,000. So 10,000 cash. When you pay, it's a minus. So you're gonna lose that money that we paid. So it's 10,000. We're gonna decrease by 10,000 on our cash because we used it. So then the difference there, if you have 25 minus 10, is going to be 15,000. So the 15,000 is what we're going to pay later. So it's on credit. So that means that we have 25,000 minus 10,000. That gives us 15,000, and that 15,000 is what we owe, because we paid part of it cash. So that means under long-term date, so we look at that transaction there under liability, long-term date, we do have it. So if we don't have it, we can put it on notes payable or account payable, something like that. So 15,000 there recorded. And the last transaction, transaction 5, the building was valued by professional appraisers to be 43,000. So 43,000, that's what it was valued. And then we know that our real value was 24,000. So 24,000 was what we recorded. So 43 minus 24 gives us 19,000. So that means we have 19,000 appreciation on the building. Remember, it's either we bought it for 24,000 or we constructed it for 24,000. But now they say it's worth 43. So it appreciated by what amount? By 19,000. So appreciation of 19,000. So that means that now we're going to record additional value on the 19,000 under the building. So we're gonna go on the building, which is part of the asset, and then record that amount of cash. That's what we're going to do. Okay, so you see that we have 24,000, that's the building, and then that's the value that the asset. So 24 minus 43 minus 24, giving us 19,000. Okay, so 19,000, we're going to record it on the transaction number 5, and the building, additional appreciation of 19,000 there. That's the value to the house, and that belongs to the owner. Okay, so the owner's equity has improved by 19,000. And then from there we need to find the total amount. So that's the total amount of everything. So we're going to look at cash, how much we have, land, furniture and fixtures, machinery and equipment. So those are the things that we need. So from those summaries that we have, we take the summaries and then we create another summary that is the cumulative to all what we have, so that's what we will actually do. Now doing that gives us the ability to see in the summary like the position of the company. So we have 14 plus 1 plus minus 10, that gives us 5,000 there. So that is 5,000 for cash. So all the cash that we have in the company for Jacksonville is 5,000, and we have machinery, nothing changed there. It's 40,000 because there's nothing changed that. And then we have 14,000 plus 25,000, giving us 39,000 there for land. And then we have furniture and fixture. So that is 30 minus 1, 3 minus 1, that's 2. And then we have 24 plus 19 is 43. So we have 43,000 there, which is worth of the building that we have. And then we come to the next one, which is 15,000 plus 3 plus 12 gives us 30. So we have 30,000 there worth of machinery and equipment. That's 30,000. And then we come to the notes payable. It's 10,000 because nothing changed there. And the notes payable, there's no transaction that could change that. And then there we have 12 plus 15 giving us 24,000. That's 27,000 actually, $27,000 for long-term date. And account payable, we have 8 plus 3 giving us 11, which is 11,000. And then we have 80 plus 12 plus 19 and paid in capital, that gives us 111,000. Okay, so now we need to see if it balances. So we take a calculator there, and then we want to see if it's gonna balance. Like, remember, the left hand side, the asset must be equal to the sum of liability plus owner's equity. And then we're going to use 5 plus 40,000 plus 39,000 plus let's just do again. 40 plus 39 plus 43 plus 3, 157. So we record that as 157 this side. So if it doesn't correspond with the right hand side, then we have to redo it, so that's how actually we count the number of transactions and the amount, total it up. And then let's do on the right hand side is 10 plus 27,000 plus 11,000 plus 111. It's a different total. Let us recalculate. So recalculating, once again, we have 5,000 plus 4,000 plus 2,000 plus 43,000 plus 35 plus 40 plus 39. So that's 5 plus 40 plus 39 plus 2 plus 43 plus 30, 159,000. So that gives us 159,000 there for the assets. And then come to liabilities. 10 plus 27 plus 11 plus 111 times 1,000. So that's going to give us the same thing, 159,000. So 159,000, that's what we have. So 159,000. And then from there, it's balanced. So the left hand side, which is the asset, is equal to the liability plus owner's equity. The next thing, we're going to create a balance sheet. So the balance sheet there will mean that we have a balance sheet, and then the balance sheet, that is summary of what we have. So remember, the transaction is supposed to be March 31. That's fine. And then we move on to 5,000 there for cash, and then we go back there and we write 5,000 cash. So that's 5,000 there. The total cash that we have in the company is 5,000. And then we go to machinery and inventory. Machinery and inventory, that's 40,000. So our company has machinery and inventory worth 40,000. So we go there and write 40,000 there. Alright, and then we have land. Land there is 39,000 for land. So our land is going to be 39,000. That's for land, 39,000. And then we have furnish and fixtures. Furnish and fixtures there gives us 2,000 for furnish and fixtures. So furnish and fixtures gives us 2,000. There's all the carpentry, computers, anything that you can move around the building, bed or whatever. Building or chairs. Building there, that's 43,000. The total value for the building. So our building now is worth 43,000. So we recorded the total value of the building as 43,000. And then machinery and equipment. So we go check on machinery and equipment. Machinery and equipment, that's 30,000. So we go there and record 30,000 and the machinery and equipment. And then from there we add. We know that the total is 159, but we just have to confirm once again. Let's confirm 5 plus 40 plus 39 plus 2 plus 43 plus 30. So it's 100. Yeah, it's 100. It's 159,000. So that's all what's worth for asset. And then we go again and record liability and owner's equity. Notes payable. Notes payable is 10,000. The notes payable is 10,000. You're gonna write there 10,000. So that's 10,000 there. Okay, and then we long-term date. So the long-term date there. Look at the total long-term date. That's 27,000 under liabilities. So liability, that's 27,000 that we owe creditors on banks and so forth. And then we have accounts payable. Accounts payable, that's strictly what we owe the creditors. So accounts payable is 110,000. So accounts payable, I mean it's 11,000. Yeah. So accounts payable is going to be 11,000. There, it's 11,000 for accounts payable. And then we need, since under liability, we need to give total liabilities. So it's 10 plus 27 plus 11 gives us 48. So our total liability is 48,000. So it's good business, I think. So paid in capital. So paid in capital is what we invested. The owner has invested in the company. Has invested 111,000. So invested, or the shareholders, what they owe. So adding that up together is $159,000. So that's our final answer. That's it. And yeah. And if you have any questions, so the left hand side balances with the right hand side, and we're done. So this is your tutor, Black Adam 5D. 5D your tutor, Black Adam 5D tutor. So that's it, and do not forget to follow or subscribe. You can go through so yeah, this is 3D, 5D actually. So 5D tutor, 5 dimension. So you find that 3D tutor, and that's it. So if you have any question, this is 5D tutor, Black Adam. That's Black Adam 5D tutor. Thank you so much for watching, and don't forget to follow or subscribe. Thank you.